the U.S. economy has been in a depression since 2007. Depression must be worse than a recession. So if recession is 2 quarters, the depression must be 10 quarters of declining GDP. A depression doesn't mean continual declines in GDP. It means below trend growth. It means depressed growth. So has the economy been growing? Yes. It grew in 2023 and so far in 2024. But it's depressed growth relative to potential, and that's what a depression is.
The U.S. economy has captured the attention of Americans as the election season heats up. While inflation has slowed to 3.5% from a staggering 99.1% in 2022, prices remain significantly higher than pre-pandemic levels. Nevertheless, the United States has consistently outperformed other advanced economies worldwide. The International Monetary Fund, IMF, forecasts a 2.7% growth for the U.S. economy throughout 2024, a notable increase from the previous year's 2.5%, and more than double the expected growth for Germany, France, Italy, Japan, the United Kingdom, and Canada. Renowned economist and investment lawyer Jim Rickards boldly asserts that the U.S. economy has been entrenched in a depression since 2007, despite occasional periods of growth like those seen in 2023 and early 2024. According to Rickards, the U.S. economy grapples with sluggish growth compared to its potential, highlighting a stark disparity between actual and potential growth, an enduring characteristic of a depression. In the first quarter, the inflation-adjusted gross domestic product, GDP, grew at an annualized rate of 1.6%, falling short of the 2.2% growth expected by economists surveyed by FEED. Dissatisfied with the sluggish growth trend of 2.2% over the past decade, Rickards challenges the conventional notion that a depression entails a 10-quarter GDP decline. Instead, he argues that sustained growth below the trend, rather than continuous GDP decline, defines a depression. For deeper insights, let's explore the video further. Don't forget to subscribe to the channel and hit the bell icon to stay updated with the latest content.
That 10-year period, 2009 to 2019, average annual growth in GDP was 2.2%. 2.2. During the Reagan administration, 1983, 1986, the U.S. economy grew 16% in real terms. That was over 5% a year for 3 straight years. That's growth. That's what the American economy can do. And even if that's not totally sustainable, you should be able to grow 3.25%, 3.5% on a consistent basis. That's what a developed economy should be able to do. So 2.2% is pathetic. I mean, you can get out the pom-poms if you like, but that's really pathetic growth. That's what we had for 10 years. And my view is that the U.S. economy has been in a depression since 2007. And people say, well, wait a second, Jim, recession is 2 consecutive quarters of declining GDP. And that is the rule of thumb. It can last 3 quarters, sometimes longer, but they tend to go 6 to 9 months of declining GDP, 2 or 3 quarters. That's the technical definition of a recession, and it is. And so people say, well, depression must be worse than a recession. So if recession is 2 quarters, the depression must be 10 quarters of declining GDP. And we have not had that. But that's not the definition of a depression. A depression doesn't mean continual declines in GDP. It means below trend growth. It means depressed growth. And it was what I was just saying earlier. If growth potential is 3% and you're growing at 2%, that gap between 3% and 2% over time is trillions of dollars of lost growth. So has the economy been growing? Yes. It grew in 2023 and so far in 2024. But it's depressed growth relative to potential, and that's what a depression is. And if you want an example, just look at Japan. I mean, Japan has been in a depression since 1989. Well, really 1990, December 31st, 1989. They rang the New Year's Eve bell, and then boom, the stock market fell out of bed. It declined, I think, 75%. It just got back. By the way, about a month ago, the Nikkei index just got back to where it was in 1989, so which is about 40,000. So nice going, guys. It took you 34 years to recover your meltdown, and that's all they've done is recover it. It hasn't gone up much since then. But Japan has had 9 recessions since 1990, 9 technical recessions. Well, you can chart the recessions, but I call it one long depression. It's a 34-year depression. And I would say the U.S. has been in a depression since 2007. So that's what, 17 years. And we got maybe we got 17 more years to go. But that's why everyone's out of sorts. That's why real incomes are not going up. That's why income distribution is, the rich get richer, as the saying goes, and they do. And everyday Americans are falling behind, and the middle class is getting wiped out. So but you can still look for a technical recession within that time series.
Inflation has persisted at around 3%, staying notably above the Federal Reserve's 2% target rate. Not long ago, the Federal Reserve seemed poised to reduce interest rates this spring, but those hopeful expectations now seem to have slipped away. Federal Reserve officials are set to maintain interest rates for a sixth consecutive meeting, signaling no immediate plans for cuts in the foreseeable future, especially after inflation turned out higher than anticipated. On Wall Street, there's speculation about whether the central bank will cut rates at all this year. Bank of America economists express genuine concern that the Fed might not lower rates until March 2025 at the earliest. However, for now, they're sticking with their December forecast. Rickards anticipates that the Fed won't cut rates in September due to potential accusations of favoritism towards one political party over another. Against conventional Fed wisdom, Rickards cautions about the looming threat of stagflation, a situation where both unemployment and inflation rise simultaneously. Now, let's shift our focus back to the video.
Wall Street's been wrong for 2 years. By the way, the expectation today is that there may be no rate cuts through the end of the year. I think that's probably right. Certainly not in May, not in June, probably not in July. And then, of course, the Wall Street people, they're always out of touch. They're staring at the screens all day. So they say, yeah, okay, you're right. Not June, not July. So they're going to raise it in September. Are you kidding me? The September Fed meeting is 5 weeks before the election. Do you think that the Fed wants to walk into the election buzz off? They cut rates in September after not doing it for last time they cut rates. 2020 was the last time they cut rates. So they don't cut rates for over 4 years. 5 weeks before the election, they cut rates. That is so obviously trying to help, or appears to be helping Biden and hurting Trump. And by the way, right now it looks like Trump's going to win. That's the last thing the Fed wants. The people say that the Fed says we're not political. They are highly political. Trust me. I mean, I've worked with senior Fed officials. I've been partners with former Fed vice chairs. I spent a lot of time with the Fed as a regulatory lawyer. They're highly political. They read the papers, as the saying goes. So they're not going to cut in September just for political reasons. Then now November, December, if you're just looking at inflation, you're not going to cut. But if you're looking at if we're in a recession, which we may be, that's a separate topic, you may have to cut because of the recession, because of rising unemployment. But the Fed thinks that can't happen, and Wall Street thinks that can't happen. I have news for you. It can happen. It has happened. So what do you call the combination? So the Fed's assumption is if unemployment's low, inflation gets high. If unemployment goes up, inflation comes down. That's the Fed's assumption. So they actually don't mind if unemployment goes up a little bit because it'll bring inflation down. But what happens when you have high unemployment and high inflation at the same time? The Fed thinks that can't happen. It has happened. It's called stagflation. Stagnant growth with inflation and prices. I lived through it in the late 1970s and early 1980s. I think around the 1979, 1980, unemployment was 10%, but interest rates were 15%. So don't tell me unemployment and interest rates move inversely. Sometimes they do, but sometimes they can both go up together. It's called stagflation. I see early signs of that. So it's a little bit troubling. But all I can say to our readers and our viewers is Wall Street always gets this wrong. The Fed always gets it wrong. The reason they get it wrong is because their models don't work. Their models are garbage. But the inflation is real. It's going to stick around. But growth seems to be slowing. So we may end up in this kind of stagflationary episode.
The pace of economic growth in the United States slowed down in the first quarter of the year after a period of robust expansion lasting over a year and a half. While this slowdown is viewed as a welcome breather, it raises questions about the trajectory for the rest of the year. Moreover, the optimism among central bankers about easing pressure on the economy has gradually waned since the start of the year. Relief from high interest rates is unlikely to materialize until 2025. What does this mean for your finances? Feel free to share your thoughts in the comments. If you found this content helpful, give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.